Okay, let's unpack this. Picture yourself in a meeting. Everyone around the table is throwing around financial terms, profit margins, cash flow,
Mhm.
equity, and you're nodding along trying to look like you're tracking, but inside it feels like they're speaking another language. Sound familiar?
Oh, definitely. You are absolutely not alone with that feeling.
Yeah, I mean, most of us never really got a formal course in Finance 101, did we?
Exactly. And what's fascinating here is how, well, universal that experience is.
Yeah.
It's almost this unspoken expectation that we'll just sort of absorb this financial vocabulary.
Right, just by osmosis or something.
Yeah, but as Stuart Warner and C. Hussain point out in the finance book, that can leave you feeling not just confused, but also, less equipped to make really smart decisions.
Totally. So for this deep dive, our mission is pretty simple, really. We're going to try and extract the core wisdom from the finance book.
And we're using that helpful QuickBook IQ YouTube summary as a guide too.
Right. Using that summary to give you, the listener, a solid grasp of finance. No business degree needed. Think of this as your shortcut to feeling, well, financially savvy.
And it's so important to get this.
Yeah.
This isn't about turning everyone into accountants, bean counters. The book is more like a guide, maybe a translator.
Yeah, a translator, I like that.
Yeah, helping you move past that initial fog of financial jargon to a place where you actually understand it. And
Yeah.
crucially, feel confident about it because finance isn't some separate thing over there.
No, it touches absolutely everything, doesn't it? Business, personal life.
Everything, as the authors really emphasize.
From those everyday business decisions like how do you price your products? Can you actually afford to offer that discount? Right through to your own personal financial planning, it's all connected.
And the central issue the book tackles is just that. So many professionals, in all sorts of roles, are expected to understand budgets, forecasts,
Things like that, yeah.
but they've never actually learned the fundamental building blocks.
So what's the real cost of that then? That gap in understanding?
Well, the book suggests it leads directly to um, less effective decision-making, maybe missed opportunities for growth or savings,
Right.
and just that feeling of not being able to fully jump into conversations when finance comes up. That silence, it can really hold you back in your career.
But here's where it gets really interesting, I think. The book kicks off with this truly liberating message.
Yeah.
Finance isn't just for the accountants or the CEOs or the spreadsheet wizards.
Absolutely. It's for everyone.
The creative director needs to know how their campaign affects the bottom line, right?
Yeah.
The entrepreneur needs to talk numbers with investors. The team manager needs to get the financial side of their team's work. And yes, that definitely includes you listening.
And the authors frame it in a really accessible way.
Hmm.
Think of finance not as some scary mystery, but just as a language.
A language, okay?
Yeah, and like any language, it has its vocabulary, its rhythm.
Huh?
Once you start to get those core bits, your whole perspective kind of shifts.
Right. Suddenly, those financial statements, the ones that maybe looked super intimidating before, all jargon.
Yeah, walls of numbers.
They start telling a story. They show you where a business is doing well, maybe where it's struggling, and where you should probably focus your attention or ask some questions.
So where does this journey into the language of finance actually start? Mm. According to the book, it begins with the basics. Business accounting.
Okay, accounting, which sounds complex.
Well, at its core, it's really just tracking the money. Money coming in, money going out. And also understanding the value the business is creating or maybe losing along the way.
Okay, so like keeping score.
Exactly like keeping score.
Hmm.
And the book really drives home how every decision a business makes ripples through its finances. Pricing, payment terms, everything.
It all shows up in the numbers eventually.
Precisely. And alongside this money flow, you've got a team of people. The book introduces the key players. Bookkeepers doing the day-to-day records. Finance managers handling budgets and reports. Controllers managing the accounting side. And then the CFO, the chief financial officer, steering the overall financial strategy.
So there's a whole structure there.
A whole structure. And it's not just people, it's the systems they use too. These aren't just software programs. They're the engine that turns all that raw data into actual business insights. Useful stuff for making decisions.
Okay, so this raw data gets crunched and then organized into what?
Into what the book highlights as the three absolutely key financial statements. First up, the profit and loss statement, or P&L.
P&L, right. Heard that one.
Yeah. As the name suggests, this tells you if the business made money or lost money over a specific time period, like a quarter or a year.
So income versus expenses.
Exactly. Income coming in, subtract all the expenses going out, and boom, you get the bottom line, profit or loss.
Yeah.
The key thing here is tracking performance over time.
The book uses a good analogy for this, doesn't it? Like a scoreboard.
Yeah, exactly. Like checking the scoreboard during a match. Tells you if you're winning or losing profit-wise right then.
Okay, P&L is the scoreboard over time. What's next?
Next is the balance sheet. Now, this is different. It's not over time. It's a snapshot, like a photo taken at a specific moment.
A snapshot of what?
Of what a business owns, those are its assets. What it owes to others, its liabilities, and then what's left over for the owners, which is called equity. It shows the company's financial position right at that instant.
So the balance sheet gives you a sense of like the foundation. Is the business solid or is it maybe shaky with debt?
That's a great way to put it. Solid footing or too much debt. Comparing assets, liabilities, and equity gives you that picture of its stability.
Got it. P&L over time, balance sheet is a snapshot. What's the third one?
The third one is absolutely critical and often misunderstood, the cash flow statement. The book really hammers this one home.
Why is it so critical?
Because a business can look really profitable on paper. The P&L might look fantastic, but it can still run out of actual cold, hard cash in the bank.
Ah, okay. So profit isn't the same as cash.
Exactly. That's a vital distinction. Profit is an accounting idea. Cash is what you need to pay the bills, pay salaries, buy stuff.
Makes sense.
The cash flow statement tracks the actual movement of money, cash in, cash out. It shows if the company is generating enough cash to cover its immediate needs and, invest for the future. It's about the sources and uses of cash.
The book's analogy for this one is brilliant too, like fuel in a car.
Precisely. Doesn't matter how fancy the car looks, like a profitable P&L, if there's no fuel, that car isn't going anywhere. Cash is the fuel.
Okay, those three statements sound like the bedrock.
They are the foundation. But as the book wisely points out, there's a lot more happening just beneath the surface. We need to dig a bit deeper.
All right, let's dig. What's first?
One key area is something called revenue recognition. This is all about when income gets officially counted as revenue on the books.
And the book says it's not always just when the cash lands in the bank account, is it?
Nope, not always that simple. Sometimes revenue is recognized before the cash arrives, sometimes after. Getting the timing right is crucial for an accurate picture of performance in a specific period.
Why? What's an example?
Well, think of a software company selling annual subscriptions. They might get all the cash up front, but they recognize the revenue month by month over the year as they deliver the service. It stops the numbers looking misleadingly lumpy.
Oh, okay. Matches the revenue to when the service is actually provided.
Exactly. Another important distinction the book makes is between operating expenses and capital expenses, often called OpEx and CapEx.
OpEx and CapEx. Okay, break those down.
Sure. Operating expenses, OpEx, are the everyday costs. Rent, salaries, utilities, office supplies, the stuff you need to just keep the lights on and the business running day to day.
Right, the regular bills.
Yep. Capital expenses, CapEx, are different. They're bigger investments in things that will benefit the business for longer than a year. Buying a big machine, developing major new software, purchasing a building.
So long-term investments versus daily running costs.
You got it. And the difference really matters for accounting, taxes, budgeting, planning long term.
So how they're treated financially is quite different then.
Very different. It affects short-term profit, how you budget, your whole long-term vision, really.
Yeah.
Now, connected to CapEx are assets, the things a business owns that have value. These can be physical, tangible things.
Like laptops, machinery, buildings.
Exactly. And the book explains that these things don't last forever, right? They wear out, become obsolete, they depreciate.
Depreciation, that's the decrease in value over time.
Precisely. It's an accounting way to spread the cost of that asset over its useful life so the books reflect its declining value.
Makes sense. But not everything valuable is physical, is it? The book mentions intangible assets.
Right. These are super important, but you can't touch them. Think brand name recognition, patents, copyrights, trademarks, hugely valuable.
And the book also talks about goodwill specifically. What's that?
Goodwill is interesting. It often comes up when one company buys another. It represents the extra value paid above the fair value of the tangible and identifiable intangible assets. It captures things like strong reputation, customer loyalty, a great workforce.
Stuff that's valuable, but hard to put a specific price tag on individually.
Exactly. It acknowledges that the whole is often worth more than the sum of its parts, especially regarding reputation and relationships.
Okay. The book also mentions stock or inventory. Managing that sounds like a tricky balancing act.
Oh, it really is. Have too much inventory sitting there and it ties up your cash you could use elsewhere, but have too little.
And you can't make sales, you annoy customers.
Precisely. Finding that sweet spot, that optimal level is the art of inventory management.
Then there's the whole world of who owes who, debtors and creditors.
Yep, unavoidable in business. Debtors are people or companies who owe your business money, usually customers who bought on credit,
Okay, money coming in, hopefully.
hopefully. And creditors are the opposite, people or organizations your business owes money to. Suppliers, maybe the bank for a loan.
Money going out.
Yeah.
And the timing of all that really hits cash flow, right?
Massively. Managing when you get paid versus when you have to pay others is key for cash flow survival.
The book also mentions prepayments and accruals. These sound a bit technical.
They can sound it, but the ideas are pretty logical. A prepayment is when you pay for something before you get the benefit, like paying your annual insurance premium up front.
Okay, paying in advance.
Yep. Accruals are the flip side. They're about recognizing revenues you've earned or expenses you've incurred, even if the cash hasn't moved yet.
Like that software revenue example. Or getting billed later for electricity used now.
Exactly. Like getting electricity in March, but paying the bill in April. You accrue the expense in March to match it to when you use the service. It just makes the financial picture more accurate for the period.
So it's all about matching income and expenses to the right time period, regardless of cash movement.
That's the essence of it, yeah. And speaking of planning, the book talks about provisions and contingencies, being prepared for bumps in the road.
Sounds like it. What are they?
Provisions are when a company sets aside money for a probable future cost that they can reasonably estimate. Think warranty claims on products, or maybe settling a lawsuit they expect to lose.
Okay, likely costs. What about contingencies?
Contingencies are more uncertain, potential future events that might happen but might not. Like a lawsuit where the outcome is totally up in the air. It's about acknowledging possible future impacts. Setting aside provisions shows good financial planning, being prudent.
Right, being prepared. The book then moves to capital and reserves. What do these mean for a company's finances?
Capital is usually the money put into the business by the owners or shareholders. Reserves, especially what's called retained earnings, are the profits the company has made over time and kept reinvested back into the business instead of paying it all out.
So money kept in the business for strength and growth.
Exactly. It's like the company's financial cushion, showing its strength and ability to fund its own future.
And what about when companies get bigger and own other companies? Group accounting.
Yeah, if a parent company owns subsidiaries, group accounting means combining all their financial statements into one big set. It gives a true picture of the whole group's performance, not just fragments.
A consolidated view. Makes sense. Lastly, in this sort of under-the-hood section, the book mentions revaluation and impairment, adjusting values.
Revaluation is updating an asset's value upwards on the balance sheet if its market value has significantly increased. Impairment is the opposite, recognizing a significant decrease in an asset's value if it's permanently damaged or less useful.
So keeping the asset values realistic on the books.
Exactly, making sure the financials reflect reality as much as possible.
Okay, that's a lot on the mechanics inside a company. Now the book zooms out a bit to the wider world of finance.
It does. It talks about things like accounting standards, IFRS, and GAAP. What's their job?
Think of them as the rule book. Standardized rules that companies have to follow when preparing their financials. IFRS is international, GAAP is more US focused.
And why have rules?
It's about consistency, comparability, transparency. So you can compare Apple and Samsung fairly, for instance. It builds trust in the numbers, ensures everyone's playing by the same basic rules.
Okay, rules for trust. And adding to that trust is the external audit.
Right. This is like an independent checkup. A separate firm of auditors comes in, examines the company's financial statements, and gives an opinion. Do these reports present a true and fair view? Do they follow the rules?
So an independent stamp of approval, essentially.
Pretty much. It adds a crucial layer of verification, especially for investors and lenders. Builds confidence.
And the book makes a great point. These financial reports often aren't secret, especially for public companies.
Absolutely. Companies listed on stock exchanges have to publish their financial reports. They're public documents. Meaning you, the listener, with the understanding we're building here, can actually go find these reports online, read them, and analyze them.
Wow, okay.
Yeah. You can get insights into a company's health, its strategy, its performance. It's empowering stuff once you know what to look for.
Definitely demystifies things a bit. Now, to make sure companies are run properly, ethically, there's corporate governance.
Right. This is the whole framework for how a company is directed and controlled. Who's on the board? What are their responsibilities? Shareholder rights, internal controls to stop fraud, ethical codes.
The system of checks and balances.
Exactly. And the book also mentions whistleblowing mechanisms, safe ways for people inside to report wrongdoing without getting punished. It's all part of ensuring accountability and transparency.
Okay, so we know how the information is put together and checked. Now, how do we actually use it to figure out if a company is doing well? Assessing financial health.
First up, profitability. Is the company making money? But it's more than just yes or no, isn't it?
It is. It's about how efficiently it's making that money. The book talks about looking at margins, gross margin, operating margin, and returns, like return on equity.
Higher margins mean more efficient.
Generally, yes. It means they're keeping more of each dollar of revenue as profit. Shows good cost control or strong pricing power. It's a key sign of health.
Okay, efficiency in making profit. Then the book mentions liquidity and solvency. They sound similar.
They both relate to paying bills, but on different timelines. Liquidity is short-term. Can the company pay its immediate bills right now as they come due?
Yeah.
Does it have enough cash, or are things easily converted to cash?
Like having cash for payroll next week.
Exactly. Solvency is long-term. Is the company financially stable enough to survive and meet its obligations over the long haul? Can it handle its total debt load?
So you could be liquid today, but maybe not solvent long term if you have huge debts looming.
Precisely. Or vice versa, though that's less common. You need to look at both for a full picture of financial stability.
And if there are serious doubts about that long-term survival, the term going concern pops up.
Yes. That's a fundamental assumption in accounting, that the business will continue operating for the foreseeable future, usually at least the next year.
And if it might not.
If there are significant doubts, maybe it's losing tons of money, can't pay debts, the going concern status is questioned, it has to be disclosed in the reports because it fundamentally changes how you interpret the numbers. It's a big red flag.
Okay. The book also mentions investor ratios. What are these used for?
These are tools, calculations using numbers from the financial statements that help investors assess a company. They can reveal trends, compare companies, spot opportunities, highlight risks.
Like the PE ratio, price to earnings.
That's a common one, yeah.
Yeah.
Shows how much the market is willing to pay for each dollar of earnings. There are heaps of ratios looking at profitability, debt, efficiency. They tell different parts of the story.
And finally, in this assessment part, business valuation. Figuring out what a company is actually worth. That sounds complex.
It is complex.
Yeah.
It's not just adding up the assets on the balance sheet. It involves looking at future earning potential, the brand strength, market position, the economy, competitor analysis.
So potential and intangibles play a big role, not just the physical
It's a
stuff.
huge role. It's a much more holistic view of the company's total economic worth.
Okay, shifting gears slightly. How do businesses get the money they need in the first place? Funding. The book mentions equity versus debt.
The two main ways, yeah. Equity funding is selling ownership stakes shares. Investors become part owners, sharing the risks and potential rewards.
So giving up some ownership for cash.
Right. Debt funding is borrowing money from a bank, maybe issuing bonds.
Yeah.
You have to pay it back, usually with interest, but the lenders don't become owners.
So keeping ownership, but taking on repayment obligations and interest costs.
Exactly. Each has pros and cons regarding control, risk, cost. Companies often use a mix.
Once they have the money, managing it well is key. The book talks about management accounts. How are these different from the main financial statements?
Management accounts are for internal use, for the managers running the business day to day. They're often more detailed, can include non-financial info, look forward with forecasts, and are produced way more often, maybe monthly or even weekly.
So tailored, frequent reports for quick decisions.
Precisely. Not bound by the strict external reporting rules. All about timely insights for managing the business effectively.
And a big part of managing is setting prices, profitable pricing.
Yeah, seems obvious, but it means really understanding your costs, what customers value and are willing to pay, what competitors are doing. Setting prices strategically to ensure you actually make a decent profit, not just cover costs.
It's not just guesswork.
Definitely not. Needs proper analysis.
Yeah.
Then there's planning, budgeting, and forecasting. What's the difference?
Good question. A budget is typically a detailed financial plan for the near future, usually 1 year. Sets targets for income, spending limits for expenses, like a roadmap.
Okay, the plan.
Forecasting is more about predicting future outcomes based on current trends, historical data, assumptions. What do we think will happen? Budgets are plans, forecasts are predictions.
And you use both together.
Absolutely. You forecast to see where you might be heading, then maybe adjust the budget or your actions to stay on track towards your goals. They're vital planning tools.
And when considering big new things like launching a product or building a factory, investment appraisal.
Right. This is how businesses evaluate if a major project or investment is likely to be worthwhile financially. Does the expected return justify the cost and the risk?
How do they figure that out?
There are various techniques looking at projected cash flows, calculating payback periods, return on investment, assessing risks. It's about making informed choices on where to put the company's money for the best potential outcome. So putting it all together, understanding these bits isn't enough on its own.
No, the real power comes from seeing how they all connect, how a decision about pricing, OpEx Rev Rec, affects profitability, P&L, which impacts cash flow statement, and influences the balance sheet, assets, liabilities, equity, and future investment decisions, investment appraisal.
It's about seeing the whole system.
Exactly. Moving from just reacting to numbers to actually using them proactively to guide strategy. That's the big shift the book talks about.
And a key part of that is not just understanding, but also being able to sort of critique the numbers, knowing when to trust them, when to question.
That's a huge takeaway. Becoming financially illiterate means developing that critical eye. Is this information relevant? Is it reliable? Is it complete? Does it make sense in the real world?
So you can challenge things, ask better questions.
Exactly. You can engage more meaningfully, spot potential red flags or areas that need a closer look. You're not just accepting things at face value.
The book describes this aha moment, doesn't it? When finance finally clicks. What's that like?
It's that feeling when the spreadsheets and reports suddenly stop being intimidating walls of numbers and start looking like maps. Roadmaps showing you where the business is going.
Seeing the story behind the numbers.
Yes. You realize finance isn't just dry accounting. It's a dynamic reflection of everything the business does, its successes, its challenges, the result of its choices.
It's like moving from being a spectator to actually being in the game.
That's a great way to put it. You understand the rules, you understand the score. Concepts like cash flow and revenue aren't just jargon anymore. They're levers, indicators you can actually use to think strategically.
The book calls this understanding a kind of superpower in business.
And it really can feel like that. Suddenly you can contribute more effectively in meetings, you might spot a gap in a forecast someone missed, see a risk others overlooked, or just make sharper decisions in your own work because you see the financial angle.
Seeing the ripple effects of decisions.
Yeah, seeing how it all connects financially.
So the whole journey the book describes is really a transformation, isn't it? From maybe feeling confused or hesitant
To feeling clear and confident. From staying silent in financial discussions.
to actively contributing, asking good questions, trusting your own judgment when you look at results or evaluate an opportunity, taking control in a way.
And the fundamental realization,
Yeah.
the core message, is that finance isn't some secret code for experts only. It's the basic language of business. For every business, every career, every dream of growth.
The book just breaks down the walls to help you learn that language.
Exactly. It teaches you to read the story the numbers are telling. Is this business healthy? Are these decisions smart? Are the plans solid?
Okay, so as we wrap up this deep dive into the finance book, let's quickly recap the ground we've covered. We hit the big three financial statements: P&L, balance sheet, cash flow, what they tell us.
Yep, and we went under the hood. Revenue recognition, OpEx versus CapEx, assets, tangible, intangible, goodwill, inventory liabilities like debtors and creditors, equity, prepayments, accruals.
Provisions, contingencies, capital reserves, even group accounting, revaluation, impairment. The nitty-gritty stuff.
Right, then the wider context.
Mhm.
Accounting standards like IFRS and GAAP, external audits, public reports, corporate governance, whistleblowing.
And crucially, how to assess health, profitability, liquidity, solvency, going concern, those investor ratios, and the basics of business valuation.
Plus funding equity versus debt and managing finances day-to-day with management accounts, profitable pricing, budgeting, forecasting, and investment appraisal.
Wow, we actually covered a lot of ground there.
We did. And the real value, the transformation the finance book aims for, is that shift from maybe feeling financial confusion to gaining real clarity, from hesitation to confidence. That's powerful.
It really is. Understanding the language of money gives you a different kind of power, doesn't it?
It absolutely does. In your career, even in your personal life.
Okay, so here's a final thought to leave everyone with. Now that you've got this glimpse, this framework for understanding the language of finance, what new questions might you start asking?
Yeah, think about it. What new questions will you ask about the businesses you deal with every day, the company you work for, maybe even just news headlines about the economy?
It changes how you see things, doesn't it?
It really can. So we definitely encourage you, take these ideas, start applying them, start asking those questions, see the world, especially the business world, through this slightly clearer, more empowered financial lens.